Take $200,000, put it into the 3 best Fidelity index funds, and leave it alone for 30 years. That money can land in 2 different places. One option is a $6.8 million account, paying you over $11,000 a month in dividends. The other turns that exact same starting cash into almost $13.9 million. Both portfolios use the same $200,000. Both buy the exact same 3 funds. The only variable changing between ending up with $6.8 million or $13.9 million is the percentage of your money you assign to each one. With hundreds of index funds in Fidelity's lineup, many overlap, effectively buying the same companies twice. To filter those out, we are using a strict rule. Every fund in this portfolio has to do a unique job the other 2 cannot do for you. Picking 3 good funds is only the first step. The data shows that your asset allocation, how you weigh those funds against each other, is what dictates your actual lifestyle in retirement. The foundation is the Fidelity Total Market Index Fund, or FSKAX. It acts like a supermarket, automatically owning roughly 3,700 public American companies at their natural market size. Because it's an index fund, there is no human manager making calls. It follows a written mathematical rule to buy and hold. That is why the management fees cost about 1/100th of what an active stock picker charges. Historically, FSKAX delivers 12.55% in annual share price appreciation. But buying companies at their natural size has a limit. The giants driving the market only count for so much. Nvidia is the largest holding, yet it is capped at its market weight of roughly 7%. If you want those tech giants counting for much more, you need the Fidelity NASDAQ Composite Index, FNCMX. Tech companies have been listing on the NASDAQ exchange since the 80s, so a fund tracking it is saturated with tech by default. It holds fewer companies overall, and the concentration at the top is extreme. Apple, Microsoft, and Nvidia alone make up more than 1/4 of the entire fund, which is what drives its 16.66% annual return. These 2 funds provide the main domestic engine. FSKAX gives you a secure reflection of the total U.S. economy, while FNCMX provides the growth required to turn comfortable savings into wealth. Putting every dollar into a single country works until the American market stalls. Between 2000 and 2010, the U.S. market finished the decade lower than it started. To solve for that, the third component is the Fidelity Total International Index Fund, FTAHX. It holds around 5,000 stocks, covering mature economies like Japan and Germany, alongside growing markets like India and Brazil. You might assume foreign stocks are disconnected from your life, but Americans use these companies every day. This fund owns global players like Nestlé and Novo Nordisk, the pharmaceutical giant behind the weight loss drugs currently in the news. Some of these foreign holdings have total monopoly power. ASML builds a $200 million machine that is the only one on Earth capable of printing the circuits inside a modern AI chip. Every single computer chip inside the American tech giants you already own likely came off a Dutch machine. FTIHX has the weakest share price growth in this group, but it carries a 16.98% annual dividend growth rate. That is better than double what either American fund managed over the last decade. You don't buy FTIHX for rapid price appreciation. You buy it as a high-yield insurance policy that generates cash when the American market hits a wall. We build the income portfolio with 50% in the international fund, 30% in the U.S. market, and 20% in the NASDAQ. That 16.98% dividend growth is the strategy's engine. A $272 monthly payout in year 1 snowballs into an $11,268 check by year 30. That $11,000 monthly check is a payout on a total account value of $6.77 million. It represents a 2% yield, which is a standard payout. It just happens to be a normal yield on a very large account. That growth relies on automatic dividend reinvestment. When a dividend is paid, the cash automatically buys more shares of the fund. More shares make the next dividend larger, which buys more shares again. That wheel accounts for 1 out of every $6 of the portfolio's total value. The income build sacrifices maximum final net worth to build a self-sustaining cash machine. You get paid for life without ever having to sell a single share to survive. Now we flip the weights for the growth build. We push 70% into the NASDAQ fund, Keep 20% in the total U.S. market and drop the international fund to 10%. Over 30 years, leaning into tech drives the total value to $13.8 million. Despite being worth twice as much as the income build, this $13.8 million portfolio only generates $912 a month in natural dividends. To get cash out of a low-yielding account, investors use the 4% rule. You sell off 4% of your shares each year to raise the cash you need, trusting that the remaining account grows fast enough to replace them. Following this rule on the growth account results in a $46,000 monthly withdrawal. However, it changes your role. You stop passively collecting checks and start actively chopping down pieces of your own money tree to fund your life. Selling shares introduces sequence of returns risk. Consider what happens if the market drops 30% the exact year you retire. In a crash, the growth account drops to $9.7 million. But you still need the cash you planned for to live. Because share prices are down, you are forced to sell 43% more shares to get the same amount of money. You are destroying shares at a low price, and they will never be there to capture the market recovery. Apply that same 30% market crash to the income build. The total paper value of the account also drops, falling to $4.7 million. But stock prices fall much faster than corporate profits. While the market value swings on sentiment, company profits and the dividends they pay stay much more stable. Your $11,000 check still lands, and you sell 0 shares. During a crisis, the growth build forces you to cannibalize your portfolio when it is most vulnerable. The income build's automated checks protect you from ever locking in those market losses. The ultimate reality is that you cannot have maximum scale and maximum safety simultaneously. You have to choose which trade-off you can tolerate. This chart maps options to your psychology, weighing volatility tolerance against your desire for automated cash. If you stay calm during crashes and manage your own withdrawals, the growth build wins. If you fear crashes and want money to arrive automatically, the income build fits. The income build provides a specific luxury. It removes the need for financial decision-making exactly when the rest of the world is panicking. The best portfolio isn't necessarily the one that makes the most money on a spreadsheet. It is the one perfectly calibrated to your specific psychological breaking point.